What's going on, guys? MMuniz here. Welcome back to the channel. In today's video, we're going to discuss the traditional IRA or individual retirement account. The reason I'm doing a video on this is there is a ton of information about these accounts that not many people know. I myself, in doing research for this video, learned a ton. I thought I had a good grasp of traditional IRAs and Roth IRAs, but really, there was a lot of stuff that I was missing. And to be honest, some of the stuff that I didn't know could really affect someone later on in life when it comes time for them to retire. Now, with that being said, I do have to say that this video is not financial advice. It's up to you guys to do your own research, determine what's best for you, and beyond that, maybe even seek out financial help if that's what you need. But this video is just for entertainment purposes only. Now, I don't want to waste anyone's time, so let's get right into the video. So first things first, what exactly is a traditional IRA? Well, an IRA is an individual retirement account that is tax advantaged. It allows you to contribute pre-tax dollars to an account. And I say account because I want to emphasize that it is just that. It's just an account. It's up to you guys to take the money inside that account and actually invest it in something like stocks, ETFs, index funds, mutual funds, whatever you're looking to invest in. But if you just put money into that account, it's just going to sit there. So the money inside of your traditional IRA, if it is invested, is going to grow, hopefully, and it's going to grow tax deferred. You are not going to pay taxes on the money inside that account until you go to withdraw the money. As soon as you withdraw the money, whether it's the gains or your contributions, you are going to owe taxes on that, and it's going to be taxed at your income brackets just as if it was paid out from a job. Now, typically, when you contribute to something like a traditional IRA, it's coming out not from your actual paycheck, but you're choosing to put the money in at a later date. So that means you've already paid taxes on it. So as an example, if you have collected $100,000 and you've paid taxes on all that money, when it comes time to file your taxes, if you actually contributed $6,500 in 2023, which is the annual contribution limit for an individual up to the age of 50, then you're only going to actually owe taxes on $93,500. So basically that $6,500 that you paid taxes on, that money is going to be owed back to you because it's contributed pre-tax. There is the Roth, which is after tax, but that's not what this video is about. So who should be contributing to a traditional IRA? Well, if you have access to it, which means you have earned income, and you can, I definitely recommend it. But the question is should you contribute to it if you have access to something like a Roth? Well, that's a great question. Typically, the common thought is when you retire, if you plan on having less income that you have now, and you're going to be in a lower tax bracket, then it's better to contribute your pre-tax dollars today because it's going to help save you money today. Now, if you feel like you're going to be investing and building a business your entire life, and then when you retire, you're just going to be collecting tons of money, then maybe it would have been better to contribute post-tax dollars in something like a Roth. But that's up to you to determine what's going to happen in your future. Most people that work a 9 to 5, they'll typically retire with a lower income. So the next question is are there income limits on a traditional IRA? Well, that's a great question because the answer is yes. And this is something that I actually didn't know. I thought that just anyone with earned income could contribute to a traditional IRA, which is true. But in order to get the tax advantage benefit of those pre-tax dollars, if you are working for a company and if they offer an employee-sponsored retirement plan, whether you take advantage of it or not, you're going to have income limits on whether or not you can contribute and take advantage. It's phased out per se. So if we go to the IRS website, we can actually see these. We can see that if you are a single taxpayer and you're covered by a workplace retirement plan, remember, you're covered by it. Doesn't mean you actually put money in it or not. That doesn't matter. It's if you have access, then you're going to fall under this. If you make between $68,000 and $78,000, that's when your phase out for the benefits are going to begin. Basically, if you make less than $68,000, then you'll be able to take that full deduction of however much you contribute. If you make more than $78,000, you're not going to be able to take any pre-tax deduction. And then if you're in between, then it's going to be phased out. If you want to find out how much you can contribute and get the full benefit, you can obviously take advantage of your accountant, or you can use the tax software. So typical tax software will help you figure this out. And the cool thing about a traditional IRA is you have up until April of the following year to contribute for the previous year. So if I want to contribute for the year 2022, I have until April of 2023 to make that decision. So I'll do my taxes in March of next year, and then I can determine if this is a good option for me and my family. So once again, your tax software can help you with that, or you can work with an accountant. Now, if you're a married couple and you want to know yours, for married couples, if the spouse making the contribution is covered by a workplace retirement plan, the phase-out range is between $116,000 and $136,000, which, if you ask me, is actually kind of low. So I'm a little bit surprised by that. So when it comes to the traditional IRA, there's a few more things you need to know. What about your money inside the account? So that money's grown and you need to pull money out of it. Well, when it comes time to do this, if you're not age 59 and a half, you're going to face a 10% penalty in addition to having to pay taxes on it. Now, there are some ways around the 10% penalty, whether it's a qualifying life event like making your first home purchase or medical expenses, or you've set up substantially equal periodic payment plans, which is confusing, but something you can do. There are many ways around this, but at the end of the day, typically 59 and a half is going to be the age you have to achieve in order to take money out without that 10% penalty. And in addition to that, if you're still working later on in life, even if you get up to age 72 and you're still working, you will be forced to start taking withdrawals. At age 72, you're going to face what's called RMDs, or required minimum distributions. And that is because you've been deferring taxes your whole life and Uncle Sam wants his money. And this is kind of where we get into some little known facts about the traditional IRA and just little tips. And the first one is going to deal with those RMDs. So let's just say you have turned 72. You actually don't need to take out the RMD the day that you turn 72. You have a certain deadline to meet. However, you do want to do it as soon as possible because you don't want to push it off until the following year, because then that leaves you with a chance of having to take 2 RMDs in the same year. And when you do that, that could potentially put you in a different tax bracket. It could potentially raise the cost of other things you're paying for in terms of benefits or insurance, kind of stuff like that. You really want to make sure that that doesn't happen to you, because it can have a large negative impact on your actual finances, especially if you have a huge amount of money saved up in your account. So when it comes to the RMDs, you don't want to wait. You want to make sure you're getting your first RMD and then you're doing it on a yearly basis. Now, another cool thing about RMDs is, what if you have multiple accounts? Let's just say you have a traditional IRA with Fidelity, one with M1 Finance, you've got a couple more. You can figure out your required minimum distributions for each one individually, but you don't need to take out money from each one individually. As long as the total amount adds up to what you need to withdraw, then you can do that from one account or from many. It's up to you guys how you want to do that. Why is that important? Well, maybe you have different investing strategies for each account. If one is meant to be taken further out in the future because it's maybe a higher risk, then maybe you don't want to take money from that one yet. Maybe the market's doing terrible like it is today. You can hold off on that one and withdraw from an account that has maybe a more conservative approach. Maybe it's not doing as poorly. So you do have a bit of options there, and you can try to time the market or whatever's best for you guys. Now, on to another cool one, and this is one that just happened to my family, is if you are not 59 and a half, but you have retired, and you are collecting income from something other than your job, you're going to have a total income, and you're going to have to be shopping around for health insurance. Now, when you're on the market, typically these are based off of how much money you make. So whether you're collecting money from investments, Social Security, disability, however you're collecting money, you have to put in how much money you're making in order to figure out how much you're going to pay for health insurance. The cool thing about a traditional IRA is it's actually considered a deduction on your actual income. So if you're a married couple and you make $50,000, and in 2022 you've contributed $10,000 total amongst 2 different retirement accounts, you can lower your income to $40,000, your adjusted income. So it's not the same as an AGI on your actual IRS tax statement, but when it comes to the insurance, a traditional IRA does count as a deduction, and that will lower your monthly premiums when it comes to the health insurance. And for the case of my family, they mentioned that it dropped their premiums by over $300 a month, which is actually insane. That's a huge savings, a lot more than the actual tax savings of the traditional IRA. And now the last little tip that I'm going to get into, another kind of cool one, is if you are filing married when it comes to your taxes and only one of you is making money currently. So one of you maybe is staying home with the kids and the other is working. That worker can still contribute to not only their own IRA, but they can also contribute to the spouse's. So even though the spouse technically doesn't have earned income, because you guys are filing married, you can have 2 separate IRAs. So you're able to take advantage for both spouses and increase the tax savings of contributing pre-tax dollars. So with that being said, that's all I got for today. I want to know from you guys in the comments, what am I missing? What else should I look into, or what do I need to know when it comes to the traditional IRA? I want to know from you guys. I do my best to respond to every single comment on all my videos. And with that being said, make sure you smash the like button down below, subscribe to the channel. We do weekly content on anything related to fitness or personal finance. I hope you guys have a great rest of your week, and I'll see you in the next one. Take care.